big moves by Centum Re, 17 billion worth of a commitment from GM. And my first question is, it looks to be like a drawdown from that provision is predicated on a listing, because I read they're following going public. Just clarify to me and to us, what does this mean?
All right. If you followed the business in the last 3 years, you will have noted a number of significant milestones being achieved. We consolidated what were previously 4 different businesses into one, Centum Real Estate Limited. We, in that period, have developed a very rich pipeline of residential projects. At the moment, what we've completed, sold, has a profitability of about 4 billion KES. And we've started seeing that reflecting in our results. 2 years ago, or about 1.5 years ago, we went through a credit rating. It's the first time we're getting our own credit rating. So if you look at the pipeline build, the traction in sales and the cash generation and that credit rating, what followed then was an issue of a corporate bond and its listing at the Nairobi Stock Exchange. What that tells you is that in that period, we focused a lot on building an investment grade asset of scale. And I would say then, listing would look to, an analyst or an observer such as yourself as a natural next step for a business that you've been building and that you've been scaling.
The 17 billion we're looking at here, as far as an equity stake would be concerned, what proportion of Centum Re would this be equivalent to?
So just to give some context into that Kenya shilling 17 billion, it's a capital, effectively it's a capital commitment from GEMS should we list or upon listing. Meaning that once we list, then they have committed to acquire at least 17 billion worth of our ordinary shares. And that effectively would then guarantee the success of the listing, or effectively underwrites that potential listing. I think what I can tell you from a percentage perspective, it would definitely not give them a majority. The idea is not for them to acquire a majority. So it would be, maybe the best way to say, it would be a significant minority.
So in terms of a timeline, because listing is definitely on the horizon, given what you have read this morning, what timeline are you looking at to go public?
What I would say is that we've embarked on a process of listing, and the milestones I described earlier, achieved in the last 3 years, can be seen in that context. It's really a background to that process of listing. So I'm not then able to tell you by this date that should have been completed, but we have embarked on that listing. And part of that process is we determining where we should list. Where should we list? Is it Nairobi? Is it elsewhere?
I'm struggling with the value proposition of listing for an entity such as Centum Re. One is because globally we are witnessing a decline of listings. People are opting for private transactions. The second thing is that your parent company has really struggled with the price to NAV gap, and I foresee a risk whereby should Centum Re decide to go to the market, well, we're not clear which market you'd be going through, but that could be a potential spillover. Aren't you bothered by this?
I take a different view. I think a listing of Centum Real Estate Limited would benefit Centum and any other investor in Centum Real Estate from a price discovery perspective. You are right in saying that the parent has had that price to NAV discount, and agreeably, then this is one of the processes that could potentially cure that. Once you separately list, obviously the business will have some value, and we feel that value is not necessarily reflected in that current NAV. If you break down the NAV at Centum between marketable securities, the private equity portfolio, and the real estate portfolio, just the marketable securities portfolio in itself, which is really a market-based securities, are almost equivalent to that NAV. So a separate listing of Centum Real Estate would help Centum and any other investor towards a price discovery. So I think it would be advantageous. As to then, the commercial rationale or the business rationale, you think about it. once we acquired the large landmarks that we acquired years back across East Africa, what we've then created is a business that has moved from a land ownership or a land holding entity to what is today a cash generative business that on a daily basis is collecting cash from sales to its customers in East Africa. So it's largely a cash generative business. The successful credit rating, the issue of a bond, the listing of the bond in itself validates that the asset in its own right has moved into an investment grade asset. If you think about, if you really ignore sectoral considerations, the model of operating such a business where I have inventory, I'm building inventory, I have finished inventory, I'm selling the inventory and collecting cash, is really no different from an FMCG. What investors are buying at the end of the day is a financial return. And as long as you're saying, this business can in 2 years sell assets, or in this case, inventory worth 15 billion shillings, it has collected 6 billion of that in that 2 years. It has a receivable of 8 billion shillings. It has another inventory and a construction of almost 6 billion shillings. An investor can then be able to get an appreciation of that cash flow and a very good, one can get a very good flavor of the likely timing of that cash flow given when these projects are completed. May I add to the question you asked earlier about the NAV? You realize because of our revenue recognition policy guided by FRS, once you sell a unit, until you complete that unit, until you hand it over, you get fully paid, and it's transferred, it's legally transferred to the buyer, you cannot recognize that profit, meaning that profitability is not reflected in any way on our own NAV as Centum Real Estate, and therefore accordingly on the NAV of Centum itself. But a listing then would allow that valuation to be incorporated in valuing the shares of Centum Real Estate.
In terms of the Centum Re business, we had a chat not too far back with James Moran. We're discussing the prospects, the offtake situation in this market, and what you are doing to ensure that at least your pipeline is robust in terms of putting out products in the market and how you ensure they are taken up. How is it thus far?
Okay. So, Gillian, I take a different view from what I have had in the market, and that view is supported by numbers. At the end of the day, everything must translate to numbers and cash. If I look at the last 2.5 years now, almost 3 years, the value of the units we have sold here in Kenya and in Uganda is slightly above Kenya shillings 15 billion. As of end of December, we had collected Kenya shillings 6.2 billion of the 15 billion in sales, meaning we have a receivable that we continue to collect of about Kenya shillings 8.8 billion. I think that tells you then a lot about just the market potential in East Africa. But number two, also about the brand itself, the Centum Real Estate brand, and the trust and credibility that the brand itself comes with. We are in the market with products across the range, from affordable to mid-market to high-end. Our portfolio of high-end products is a small component of the overall. The larger part of our product portfolio is primarily on the affordable housing space and in mid-market. And we believe, and that this is supported by current market observations and dynamics, that there remains a significant undersupply, especially on the affordable mid-market space of that market.
Now that Centum Re seems to be carving itself out as an independent and an entity gradually, how would you like your debt to equity mix to look like ideally?
For Centum Real Estate, it's really an easy capital structure because as a developer, the capital structure really is guided by the funding structure at a project level. So for every project that you initiate, because the project is ring-fenced, or the cash flows in a project are ring-fenced, and we typically use SPVs for every project. At the time we are approving a project, it comes with a fully funded capital structure, which shows how much debt at project level, how much equity at a project level, and how much customer deposits are expected to be utilized towards that construction. So whenever we take any debt, it's debt at project level, meaning that it is fully covered by the project inventory, whatever you're bidding, by the project property and inventory, and by the receivables within that project. It's not a corporate level facility, which is the typical model of any real estate company. So it's a project finance ring-fenced at the project level, meaning that outside of that project, then there is no recourse to any other project or at the corporate level. That's typical. So if I look at this 17 billion discussion, other than of course, giving the advantage of price discovery to our investors, giving them a form of liquidity in the future for their shares, it also starts to build now new equity that allows us to grow into the Pan-African business we have always aimed to go. So this is really raising equity that would allow us to do even more projects outside of our current geographical areas of focus, which is today Kenya and Uganda.
Probably my next question, because clearly when you raise this sort of capital, man, definitely you have aggressive expansion plans beyond your traditional markets. Just give me some insight, please.
Okay. I think we are very aligned with our parent in terms of the geographical focus. Our parent has always been a Pan-African focused business, creating opportunities in Africa. We as Centum Real Estate as well, today we are in East Africa only, Kenya and Uganda, but this is from our mission and our vision, we are a Pan-African homes developer. And therefore, yes, we do have intentions of expanding beyond our geographical areas of focus into the wider Africa. We see a lot of opportunities. We see a lot of similarities in market dynamics between our local market and similar markets in the wider Africa. And you should expect that in the medium term, you will see moves and announcements towards that growth.
Sam, I was really intrigued by the 36 months provision attached to the facility. And I struggle with that because I'd imagine if you're going public, you need this capital almost on a snap for you to have a guarantee, if I could call it, that your issuance would be well subscribed. Why 36 months?
Think about it, Julian. You're saying we, on the one, you go list, so you go through an IPO listing, meaning you do have the primary investors who will invest in your shares at that primary listing. If you take a scenario where all shares available or being issued at the primary listing are taken up by any other investors, it then means we do not have to tap or to draw down on this facility through issuance of additional shares. If there's a shortfall between our target and what has been subscribed to by other investors, then we start tapping into this facility up to 17 billion case, and you have 36 months to do that. So effectively, then what does is to underwrite that issuance. It's not different from your typical underwriting process for any issuance of shares.